You've probably heard this before, right? Just withdraw 4% from your investments each year and you'll be safe in retirement, right? Rainbows and Skittles, right? We've all heard that. But is that actually safe? But here's the truth. In today's world, the 4% rule might be as safe as leaving your front door open with a sign that says free stuff inside. We know back in the 90s that there was a guy, I think his name was like William Bennigan, and he ran some numbers. He found that if you had a balanced portfolio, which means half equity, half stocks, and then half of it is bonds, which is debt, that you will be able to retire, withdraw 4%, and it should last about 30 years. And boom, the 4% rule is born. The problem is we don't know if that is safe in today's environment. Now, I love the 90s. Back then, I had a better hairline, the music was fun, but it was a completely different economy back then. And there are four main reasons why the 4% rule might not work in today's environment. Number one is people are living much longer. What if 30 years is actually not enough? The numbers showed that if there is a couple that makes it to 65, both of them are 65, that there is a 50% chance and one of them will make it to 90. Number two is inflation is a really big deal. And the idea of doing the 4% rule, it might not be able to cover inflation as efficiently as we need it to. And one of the things that we don't often think about is the bond market, the debt that you would buy. You're getting a much higher return from the bond market back then. You and I both know that from like 2010 to 2020, you are literally getting close to 0% return on all of the debt. And the bonds was very difficult to build a retirement strategy off of that. And you even see in today's economic environment, we have $40 trillion in debt, and we're contemplating whether we should lower interest rates. The president is asking every other month, lower the interest rate. The Fed is saying we're just going to hold interest rates because we don't know what the future looks like. With the tariffs and the market uncertainty, we're not sure whether we should raise or lower interest rates. So the Fed has kept the rates flat for maybe the past like three meetings that they've had. The environment that we're in now is much different, but the idea that the interest rates will be high and they'll remain high is much less likely as it was back then. And the fourth reason the 4% rule might not be as safe as it once used to be is because people are having a lot more fun than they thought they would have in retirement. We're thinking, oh, 4% of my investments, I can live off of that. Life is going to be easy, rainbows and skills. But then there's a trip here, you get invited to a concert there. And next thing you know, you're remodeling your kitchen, you're getting a new vehicle, you're doing all these amazing things. And you find that you're spending a little bit more than you expected in retirement. So let's talk about some of the hidden risks that people will have to deal with in retirement. For that, what I'll do is I will share my whiteboard with you. And so when I talk about some of the hidden risks, let's start with some that we don't think about as often. Number one is going to be sequence of returns. And all we're saying with sequence of returns is when I lose my money matters. I recognize that I'm going to lose my money because that happens in the market, especially if we have a diversified portfolio. That means that a portion of my portfolio should perform well in a variety of economic climates, but it also means a portion of my portfolio is not going to perform well in a variety of economic climates. And we're going to be hedging our risk with how we design our portfolio. Our sequence of returns is recognizing that if we have a loss in the beginning of our retirement, so if I have a loss here, so let's say I have like $1 million and I start here, if I have a 15% loss out the gate, I then can start having a small increase, but then I'm investing and taking out my money, and then I normally run out a little bit quicker. And so that ends up being around 18 years. But if you have it the opposite, where you have your $1 million and it's growing a little bit, and then you have the 15% loss, well, you can see that we still end up making it further into retirement. It's not just about how much we earn, it's about when we earn it. Because the reality is, even if our averages over our life of our retirement are that 4%, if we have the dip earlier in retirement, it increases the likelihood of us running out of money, even though the averages are just fine. The second thing that we'll normally look at is going to be our taxes. Now, I talk about taxes a decent amount, but a lot of people don't really think about taxes. We assume once I stop working, then my money is not going to be taxed as much. But the reality is, your Social Security can be taxed, and the numbers to be taxed is very low. In fact, I believe the likelihood of you getting up to 85% of your Social Security considered taxable income is almost a slam dunk because the number is really low as far as if you, I think it's like $30,000, $40,000. And for most people, their Social Security by itself is already going to make it taxable because if you're over $23,000, a portion of your Social Security is going to be considered taxable income. Maybe not the 85%, but a portion of it. And then most people have their money inside of their 401k. Well, what's the issue with having our money in our 401k or your 403b or really any pre tax account that you would be dealing with? Because this money has not been taxed yet, it is taxed as ordinary income when you retire. And the 4% rule feels more like 5.5% after Uncle Sam takes his cut, especially if most of your income is in a tax deferred account and consider ordinary income in retirement. Ordinary income is some of the highest and most inefficient forms of taxes that you and I's income can have. That if I have rental income, I have a lot of tax breaks that I can have to lower my taxable income. If I have business profits, I have ways that I can lower that taxable income so that way I don't get taxed as much. When it comes to your ordinary income, there are not that many tax breaks that are available to you, which means it's a higher probability that you'll be taxed more. Even when you compare it to things like capital gains, which is money's been invested for a year and a day, when I sell that to then use it as income, that is taxed at a much more favorable tax rate than ordinary income. If we're not thinking about taxes in our retirement, that's a lot less money that we actually get to put in our pocket and spend in retirement. And ultimately, that is the goal, to have more of my money in my pocket when I need and want to spend it the most. And then third on our list is going to be healthcare costs. Healthcare is like a subscription that you didn't sign up for, but you have to pay it anyways. And when you look at things like long term care, and you see that 7 out of 10 people will have at least one long term care episode, that means that we have to have money set aside for that. And when you look at it, we know that it's not crazy for long term care to be 60K a year, and when you look at the averages, it's on average 3 years over the life of our retirement. Then when you look at other healthcare expenses just in general, then you're starting to say, all right, there's a Fidelity study that says that we'll spend 200 to $400,000 over the life of our retirement on healthcare expenses. About 150 to $200,000 if we're an individual, and about 350 to $400,000 if we're a couple over the life of our retirement. Well, most people recognize that healthcare is one of the things that actually just outpaces even normal inflation. That if we said normal inflation is like 3% each year, when you look at things like college and healthcare, those two way outpace inflation, sometimes twice as fast, where your healthcare expenses could be 6% higher in any given year. Just like your kids when they go to college, you've seen it where the cost of college is going up a lot every single year. So that might mean that our 4% rule is not actually going to be able to maintain the healthcare I need so that I can enjoy my retirement and have all the fun that I'm looking to have. Okay, deep breath. It's not all doom and gloom. You can have a withdrawal strategy that I like to call a dynamic withdrawal strategy, and that gives you the ability to adjust as the market adjusts. When you're looking at things like higher inflation, it might mean that I have to have a portion of my portfolio that's invested a little bit more aggressively so that I can make sure I keep up with inflation. And for me, you all know that I'm big on using the three bucket strategy. And the reason I like the three bucket strategy is it ensures that I do keep up with inflation. So that way I'm able to spend my money and maintain my lifestyle without having to worry about actually running out of money. And so when you look at the three bucket strategy, normally what we do is we have a portion of our bucket that is focused on cash and cash equivalent. And this is normally going to be 1 to 2 years of your living expenses. And so this could be cash, this could be CDs, it could be a money market account. Then my middle bucket is normally going to be my income focused bucket, and that this is going to be a little bit more moderate. The goal of this bucket is to keep up with inflation, really close to inflation. We're not trying to beat inflation, but we recognize we need a portion of our portfolio to, at the minimum, be around inflation. And so normally that is going to be bonds. For many of you, it could be someone's annuity, right? If you're focusing on income as well, you get the interest payments, and then you have your annuity payments as well. We're normally going to be somewhere around that 3 to 8 years for this bucket. And the idea is if I have 2 years of living expenses, I no longer have to worry about sequence of returns. It also means if I have a portion that is at minimum around inflation, I feel more confident that I'm going to be able to keep up with rising costs, whether it's healthcare or different things like that. But because I know healthcare way outpaces normal inflation, I'm really going to focus on my aggressive bucket, which is going to be focused on growth. When I have my aggressive bucket, Now I know that I have a portion that should way outpace inflation. So now I can afford my healthcare expenses. I can afford those extra tricks that I want to have. I have my needs covered with these two buckets, my cash and my moderate income bucket. My needs are covered. I can pay my light bills. I can keep the lights on. I can put food on the table. I can keep gas in my vehicle. I can go to my doctor some. That's going to be covered in these two buckets. I need my aggressive bucket to make sure that I'm outpacing inflation so that I can have my fun. And then if something does happen or have a long-term care issue, I have the money that's set aside to cover it. And so the thought is in my aggressive bucket, that could be your own personal business, that could be real estate, that could be individual stocks, and it really could be any of them. It could be different ETFs, and even my commodity levers. You can put commodities in here as well. When we're talking about things that we consider aggressive, we basically mean, does it have the ability to go to 0%? That is a very safe way to consider something aggressive. Your cash doesn't really have the ability to go to 0%. You have $1,000 in your savings account today, you probably have $1,000 in your savings account tomorrow. Normally, you're invested in bonds, the same idea. You give them 1,000, they pay you the interest payments, you get your $1,000 back. Now, there are aggressive bonds, which would be like high yield bonds, which are really just junk bonds, but that is not what we're focusing on in the income bucket. In fact, I'm seeing people that would consider blue chip dividends, so blue chip dividend stocks, where they would get maybe like a ETF or a mutual fund or something like that. And the idea is if I have all the blue chip companies, like Fortune 100 companies that pay out dividends, the likelihood of AT&T or General Electric or Google and Apple, yeah, the likelihood of these companies going away tomorrow is really slim. They don't really give as much on the growth side because they're very mature companies that have a large market share, and there's not much that Coca-Cola can do. It's already in most of the places that we go. They spend a gazillion dollars every single year just running Coke commercial ads so that you're literally just kind of thinking about Coke, but they know that there's not that much more market share that they can get. So that means that this is a less risky investment. And part of the reason we would consider having blue chip dividend mutual funds, where that is going to be something that is a little bit less risky, but it depends on your overall risk appetite. And so normally when you're doing that, I now have a portion that is just basically keeping up with inflation. I have a portion that is outpacing inflation. This is normally going to be my 10-year plus folder. And the reason it's 10 years plus is because my business could lose money, real estate could lose value, my stocks could lose value, but it's probably not going to happen over a 10-year span, which means that as long as I don't spend the money when the asset is down, it will return. And you can think back to COVID, or you can think back to the tariff stuff that we were dealing with in 2025, where you lost $6 trillion in the stock market in the first quarter, and the stock market has recovered that $6 trillion and then some in the second quarter. We just need to have the time for the value to recover. Generally speaking, right? Historically speaking, the value recovers. It's not to say that it's always going to do that. It's just say, historically speaking, the value always recovers. And then you can see that even when we had the Great Recession in the 2009, we saw that 2010 to 2019, the stock market had one of its best bull runs ever, because that's just generally what happens. The stock market does recover. We just need the time to enjoy that best bull run ever. And if we're already taking money out for our retirement, then sequence of returns means that we're losing money and we're locking in those losses. It increases the likelihood of us not having any money later into retirement. So you're going to want to build a dynamic investment strategy that adjusts with you when the market adjusts if you want to make sure you don't run out of money. I will give you a couple of examples that other people also like doing. And so, in this particular case study, what we're going to do is we're just going to focus on the spending strategy, so the withdrawal strategy. And the goal is for you to be able to see how it does have an impact on whether or not you run out of money or not. So, currently, this withdrawal strategy is in inflation adjusted. And so that just means that every time we consider inflation, so I believe in this model, we consider inflation 3% every year. You increase how much you spend by 3% every year, and you can see that that gives this particular person a 76% chance probability of having money at the end of retirement, and they would have somewhere around $2.5 million in their portfolio. What we're ultimately saying when we're looking at these probabilities of success is we're running like 1,000 scenarios. And all we're saying is, out of those 1,000 scenarios, how many times do we make it to 90 years old without running out of money? And we're saying 76% of the times, so 760 of the 1,000 times we have the money at the end. Now, how close we are, then that would bring you maybe to like 85, 90%, or maybe I just was off like $100 or I was off $1,000, something like that, where you probably could have made the adjustment if you needed to. And so somewhere in there, we normally want to be over 70%. If we're over 70%, we feel relatively good about it. And so that's what that one is. Now, look what happens when I change the spending strategy. So if I change it to the retirement smile spending strategy, which is just a very fancy way of saying that we spend a lot more early in retirement and then we spend a little bit less in the middle of retirement because we're sort of done with all that stuff. And at the end of retirement, we spend a lot more on healthcare. You can see that there's an additional $1 million in this person's account just because we changed the way that we spent the money, where we slowed our spending down, which is actually more common that we actually have a retirement spending smile. And then if you were to change it to the retirement spending stages, you can see that the retirement spending stages ends up adjusting our probability of success down to 79%. So it's somewhere in the middle between the retirement spending smile, but it's better than just worrying about inflation and increasing each year. And so when you're talking about the retirement spending stages, what we're basically saying is we spend differently as we're in a different stage of retirement. And what we're basically saying is in the first stage, when I retire to 74, I'm just going to spend my regular retirement expenses adjusted for inflation. I'm not going to make any changes. My assumption is I'm going to live my retirement best life for that first stage, as most of us do. We do the traveling, we do the adventures, we do a little bit of everything. But then the second stage is we would expect to slow down a little bit, where we don't want to do as much of that stuff. And so the second stage is 75 and 84. And so we'll decrease our retirement expenses by 10%. And then the third stage is going to be 85 and higher. And what we'll do is we're going to account for the fact that I do pay a little bit more for healthcare. But in my third stage, I would expect it to be 5% lower than what it originally was. And that's what the idea of the stages is, that you and I will go through stages in retirement. And because we go through stages, we're not going to spend the same throughout retirement every single year, increasing with inflation. It's not impossible. Maybe if you have things like a golf membership and you really enjoy the trips and the traveling, that you live that way every single year. But for most people, they do make adjustments in how they end up spending. And then guardrails, this is another dynamic one. And all guardrails is saying is that when the market makes more, I spend more. When the market makes less, I spend less. And you can see that if that is your plan, the median value of your account goes down from that 2.5 million that we just saw all the way down to $100,000. And the reason is we have changed our withdrawal strategy. That if the market makes 10%, and let me show you what that ultimately would look like real quick. And so if you were someone that is thinking about spending with a guardrail, all you're basically saying is, I'm going to, let's say, take out 4% every single year. But if the market makes more, I'm going to take out a little bit more. So maybe I put a cap at 7%. So I say if the market makes more, I'm going to enjoy that little bit of a wave and I'm going to spend a little bit more that year. So that is one of my guardrails. Even if the market makes 10%, I'm not going to spend out the 10%. I'm going to cap myself at 7%. That's one of my guardrails to keep me from running off the road. If the market loses money, I am going to decrease how much I spend or my money, hoping that it allows my retirement savings the time it needs to recover. So, what I would do is if in 2025 I start my retirement, I take out 4%, but then the stock market had an 8% growth, then in 2026, I'm going to take out my cap. So, I'm going to take out 7%. I'm going to enjoy the fruits of my labor. But then in 2026, and let's say the stock market had a 1% return, well, in 2027, what I would do is I would not take out the 1%, but I would go to my floor, which is 2%. Because I don't want to take out a bunch of money next year when the market went down, but I know I took out extra money last year when the market went up. And that's why in this particular case study, it didn't work for them because there was a lot of good years in the beginning. And as a result, they took out a lot of extra money. And then later in retirement, as things started to shift and the market had adjustments, they weren't able to really recover the same way. And for the floor and the ceiling, what you can see is we have the floor, so we limit our spending reduction. But all we're saying is that my reduction is limited to 15% below my initial retirement expense amount, inflation adjusted. So we'll keep the math easy for me. So if I was spending $100,000 a year, I cannot go below $850. That is what my floor is, no matter what the market is doing. I will take less when the market is going down, but I'm not going to go below $850. And then the ceiling is the same idea. I can increase my spending if the market is doing really well, but I won't go past 20%. And the math would be relatively speaking the same idea is that if I had $100,000 and then the market went gangbusters, I'm not going to take out more than $120,000 that next year. Now, we do adjust for inflation inside of the floor and the ceiling to make sure that you're maintaining your overall lifestyle. But these are what we would consider dynamic withdrawal strategies, where you're able to make adjustments as the market adjusts, which increases the likelihood of you not running out of money and you can enjoy and actually have a safe withdrawal strategy. Another dynamic withdrawal strategy that I do like to think about is going to be from a tax perspective, where we're thinking if I have required minimum distributions and I have ordinary income tax, is there a way that I can dynamically withdraw my money from a tax perspective? So I don't just take the money out of my 401k and then out of my investment accounts and everything equally. I strategically choose the order that gives me the most money at the end of retirement. And sometimes that means we do Roth conversions where we live some early years only on our tax deferred accounts. So that way I can do the conversion, give myself tax free income in retirement, and then I can spend some of that a little bit later. I can start as early as 50 while I'm still working. I can start at 55. I mean, there's so many ways that we can do it. But you can see in this particular case, what we're able to do by doing these Roth conversions, and we set the Roth conversions basically anytime their taxes were below 10% as their ordinary income, we went ahead and did Roth conversions to bring them back up to 10%. And so what happens is sometimes as you retire, your income takes a hit. And if your income is lower, you're thinking, all right, well, I have a 5% tax rate this year. I have a 0% tax rate this year. I have a tax refund this year. But instead, if you just said, well, I've been paying 10% every year, maybe I just maintain that 10%, or maybe I maintain that 20%, and then I do my Roth conversions. Now in retirement, I have tax free income. And my retirement withdrawal strategy is much better. I don't have to worry as much about going aggressive because I already at a minimum have an amount where I don't have to cover the taxes. And so that ends up working very well for a variety of people. And so for this particular case, you can see that doing those Roth conversions, we're able to generate an extra $1.1 million in their ending balance in their account. We're able to save them about $200,000 in taxes. And because they didn't have those required minimum distributions requiring them to take out large amounts of money later in retirement, they were actually able to leave about $1 million more in their tax deferred accounts. So that way they're able to save on taxes, have more generational wealth, if that's what the plan was, but at least have the flexibility of choosing when and how to spend your money. They were able to get all of those benefits simply by doing the Roth conversions early on. And so I know what you're thinking. You're thinking, all right, Dre, that's a lot of information. What are three things I can do today to help me with my retirement plan? And I'm glad that you asked. Number one is I would get clear on our spending. How do I think I'm going to spend my money in retirement? Am I going to be spending an increased amount on a regular basis? If that's the case, then maybe I have to have an inflation adjusted strategy. Do I think it's more accurate for me to be in retirement stages or the retirement spending smile? Depending on how you believe you'll spend your money, that is how we decide what the withdrawal strategy would be. As far as your spending, then we can say, all right, based on that, we need to have your three bucket strategy allocated in a specific way. Where maybe if we have to spend more, we have a slightly larger amount in the growth bucket. Where maybe someone who's spending less can have 40% in growth, but someone who's spending more may need to have 50% in growth. Where someone might be able to have 30% in cash, where someone else might be able to get away with 15% in cash. And so we're going to figure out the allocation for those three bucket strategies, but that starts with determining what your dream retirement looks like. What are the things I want to spend my money on? Do I want to take the trips? Do I want to volunteer? Do I want to pick up a hobby and learn golfing or pickleball or something? Based off of those answers, we then put a price on it and then we build a retirement plan to cover it. Then from there, we would then normally do stress testing. And so let me give you an example of what a stress test would look like. All we're saying when we say stress testing is, hey, I know the probability of me running out of money is low, but if the market gets crazy, if Social Security doesn't come, if I live a little bit longer than expected, what does that do to my retirement plan? And so you saw that we had as a baseline 88% chance of success based on the Monte Carlo simulation. Well, what if the market drops immediately? When you say immediately, what do you mean? I'm saying the market drops by 20% in the first 2 years of your retirement. Well, that goes from 88 to 80. I would still be okay. What about taxes? Well, if taxes, what do you mean by tax? I mean, what if taxes are higher by 20%? Well, if my taxes are higher by 20%, I'm still going to be okay because I've already done a lot of the rough conversions. I have a lot of tax free income. So as a result, whether the taxes go up or down, I'm living clean. And then you'll move on to Social Security and say if Social Security was to be reduced by 20%, then that would actually have one of the most damaging impacts on this retirement plan. And then you see the longevity. If I live 5 years longer, not a big deal. If inflation is 1% higher, most people are surprised by just having a 1% higher inflation every single year, though compounding, that ends up being the second most dangerous impact on this person's retirement plan. Healthcare is a little bit more expensive. What do you mean by that? Just costs 20% more. Well, I'm probably going to still be okay. And then I have my assets. If my assets get a little smaller return, what's that? Just 1% a year. Okay. If my assets have a 1% return, a little bit lower, you can see that things that compound like inflation in your assets, that 1% does add up. It really does impact it a lot. And so what we would normally do is we would say, all right, based off of this, I have an 80% baseline. That's just assuming, hey, we're in 1,000 scenarios. This is my likelihood of success. And then if you took that and then just decreased the likelihood of success, you can see that we're still over the 70%. So we feel pretty good about this retirement strategy. Now, the third one is, of course, you would just consider asking a pro, and I would be that guy for you. If you were interested in having a conversation where you have a retirement risk assessment, I'd be complimentary, it'd be free. We would plug the numbers in, we would run the stress test. We would see what is the risk in your retirement plan. Where for your plan, maybe the increase in taxes devastates your plan. Well, maybe we then need to put something in place to ensure that taxes don't impact your plan that strongly. If the market drop is what impacts your plan the most, then maybe we need to make an adjustment to your portfolio allocation so that way you protect yourself from that risk. And the same would be with longevity and inflation and everything else. That depending on where your money is currently and the lifestyle you want to have in retirement, that is what tells us where we're most vulnerable to having a safe and successful retirement plan. If that is something that you want to do, I'll put a link in the show notes. We can get together complimentary about 30, 45 minutes. You'll place your information into this type of a program, and then I will meet you and we'll go over the plan, and then I'll give you as much value as I can in the time that we have. Again, I'll place a link in the show notes for you to be able to do that. Get on my calendar and then we can get together. As always, I'm thankful for the time that we have together. I do not take it for granted. I know you could have been anywhere and you chose to be here with me. If you found value in this video, I simply ask for you to like and subscribe so you can continue receiving valuable insights on how to build your own wealthy retirement system. Until next time, stay safe and enjoy life.